Hello, this is the 23rd episode of What Would Peter Lynch Do that explores the wisdom of legendary investor Peter Lynch. Today, we're diving deep into a question from one of our curious listeners. They recently asked, Costco stocks have been rising for a while, and expectations for a stock split are growing. What does it mean to split a stock? Even though there is no change in the actual value, the stock price goes up just because of the split. Can you explain why that is?
That's such a common question, isn't it? And honestly, it's one of those financial concepts that can feel, well, a bit counterintuitive at first. So for today's deep dive, we're going to really unpack stock splits, explore their less talked about opposite, reverse stock splits, and figure out what they truly mean for you, the investor. We'll get into the mechanics, the psychology, and I think most importantly, what Peter Lynch and maybe some other investment giants would advise when you see these events unfold.
Exactly.
Okay.
Our aim today is really to demystify these ideas, put them in clear terms, especially for those of you who might be relatively new to stock investment. And we'll try and connect them to some broader principles too. Ideas about smart decision-making that actually go far beyond just stocks.
Okay, let's unpack this then. The listener asks, what is a stock split? I mean, on the surface, it almost sounds like some kind of, I don't know, financial magic, right? You cut something and suddenly it looks like it's worth more. What's really happening here?
Yeah, it definitely feels a bit like magic sometimes, but no, it's not. Simply put, a stock split is literally dividing one share of stock into multiple shares. So you might hear about a 1-for-2 stock split or maybe a 2-for-1 stock split, and that just means one existing share is now becoming two shares. But here's the crucial point, and it's something Peter Lynch would absolutely hammer home. A stock split does not change the total value of the company or the total value of your investment stake. Think of it this way, right? It's like exchanging a $100 bill for two $50 bills. Your total amount of money stays exactly the same.
Yeah.
You just have it in, smaller denominations. That's fundamental.
That analogy makes it really clear. But then, why? Why do companies even bother going through the trouble if the overall value stays the same? What's the point?
Right, that's the million-dollar question, isn't it? Well, there are two primary, very practical reasons companies do this. First, it's about what they call improved investment accessibility. See, when stock's price climbs really high, maybe like $1,000 a share.
Yeah, that's a lot for one share.
Exactly. It can be a real barrier for individual investors, especially those working with smaller budgets, maybe preventing them from buying even a single share. So if that stock splits, let's say 10-for-1, and the price drops to $100 a share, well, suddenly someone with $100 can buy a share. It makes the stock more attainable for, a wider pool of people. And second, this improved accessibility often leads directly to increased liquidity.
Liquidity, meaning easier to buy and sell.
Precisely. More shareholders, more people actively trading.
Mhm.
It just makes it easier to buy and sell the stock quickly in the market without causing big price swings. And higher liquidity, that's generally seen as a good thing for investors.
Okay, so accessibility and liquidity makes sense. But here's the part that I think really trips people up, like our listener mentioned. If it's just financial reshuffling, like swapping bills, why does the market often react so positively? Why does the stock price actually go up when a split is announced? Is it just irrational excitement?
Yeah, this is where it gets really interesting. It's a fascinating mix of psychology and market dynamics. That immediate upward bump you often see around a split announcement. It's mostly driven by psychological factors. First, there's that anticipation of increased accessibility we just talked about. Investors basically expect that the lower per share price will attract more individual buyers.
So they buy before those new buyers show up.
Kind of, yeah. They anticipate increased demand, which they think will push the price up. So it becomes a bit of a self-fulfilling prophecy, at least in the short term. Secondly, a stock split is almost always seen as a positive signal. Think about it. Companies that announce splits are usually ones doing pretty well, right?
Yeah, their stock price has probably gone up a lot already.
Exactly. They're typically high-performing companies with strong growth. So by splitting the stock, management is sort of signaling confidence. They're saying, we expect continued growth. Investors read that confidence as a very positive sign about the company's future. And finally, there's a subtle thing called the cheaper price effect. Even though we know the value hasn't changed, that lower price per share just psychologically feels cheaper to some investors.
Like a mental bargain, even if it isn't really.
Right. It can simulate more buying interest, maybe from people who felt priced out before, or just from people reacting to that lower number. So all these factors, they combine to cause that temporary rise in the stock price right around the announcement.
Okay, temporary. So we see this pop around the announcement, but what happens after that initial excitement? Does the price just keep climbing because of the split itself?
No, not really. That's a key distinction. While that immediate price jump is common, the split itself doesn't fundamentally change the company's underlying value. So it doesn't guarantee sustained long-term appreciation.
Mm,
So before or immediately after the announcement, yeah, you typically see that price surge. We talked about why those psychological factors. And then in the short-term effect, right after the split actually happens, you might see another little bump, maybe higher trading volume for a bit. But this effect is usually pretty short-lived.
hmm.
The long-term perspective is what really matters here. Ultimately, the stock price is going to move based on the company's actual performance. Its growth potential, how competitive it is, all those core intrinsic values, basically what the business is really worth and how much money it's making and expected to make. A stock split can act like a spark, maybe igniting a bit of a rally, but it can't be the fuel that sustains it. Think about, say, Tesla and Apple.
Right, they both split their stock.
They did, yeah.
Oh.
And their stock prices rose around those announcements. But their long-term success, their real appreciation, that came from their continued core business growth.
Hmm.
Tesla's EV innovations, Apple's whole ecosystem.
Hmm.
That was the real driver. They didn't rise simply because of the split itself. The split was more like a reflection of past success.
Got it. So splits are like cutting the pie into more slices. What about the opposite? Can companies like glue the slices back together? Is there an opposite to a stock split?
Absolutely, there is. It's called a reverse stock split, or sometimes you'll hear it called stock consolidation.
Reverse split. Okay.
Yeah, and it's exactly what it sounds like,
Good.
combining multiple shares into one. So, for example, a 1-for-2 reverse stock split means two existing shares get combined into a single new share. And just like with a regular split, this is crucial. A reverse stock split does not change the company's total value or the total value of your investment stake.
Hmm.
So if you own, say, 10 shares trading at $1 each, your total value is $10.
Right?
After a 1-for-10 reverse split, you'd own just one share, but it would be worth $10. The total value hasn't changed. It's still $10. Now, companies usually do this for reasons that are pretty much the opposite of why they do a regular split. It typically happens when their stock price has fallen, often quite low. One key reason is to improve company image. A really low stock price, what people call a penny stock, trading for maybe just a few dollars or even cents.
Yeah, that doesn't look great.
It doesn't. It can signal poor financial health or just a lack of credibility.
Mm.
So consolidating shares makes the price look more substantial, potentially more attractive. Another really important reason is to meet listing requirements. Big exchanges like the NYSE or NASDAQ, they have minimum share price rules, like maybe a stock has to stay above $1 per share.
Ah, so it drops below that.
A reverse split can bump the price back up and prevent the company from getting delisted, kicked off the exchange.
Yeah.
And finally, a higher share price can sometimes help attract institutional investors.
Right.
Some large funds or institutions have rules against buying very low-priced stocks.
Okay, so this leads perfectly into that common bit of wisdom you sometimes hear. Generally, people say that split stocks are good to buy and consolidated stocks, meaning ones that did a reverse split, should be avoided. How true is that really? Is it that simple?
It's a very widely held belief, and look, it serves as a decent rule of thumb, but no, it isn't always true. It's definitely more nuanced than that. Let's take the suitability of split stocks first. Yes, those are often a positive sign. Why? Because, as we said, splits usually happen when a company's doing well, its stock price has gone up, reflecting real growth and success. So yeah, these companies are often seen as good investment targets because they're already demonstrating strength.
But there's a but, right?
There's always a but. Here's the really crucial cautionary note. You shouldn't invest based solely on the split, ever. You must still do your homework. Thoroughly analyze the company's actual value, its future prospects. Just remember this. It means good companies split their stock. Not splitting stock makes a company good. The split is often a symptom of success, not the cause of future success.
Got it. Symptom, not cause. Okay, what about the other side? The reverse splits, the consolidations.
Right. Regarding the suitability of split stocks, well, they're often a sign of company distress. It usually happens because the stock price has fallen sharply, maybe indicating poor performance or financial trouble. Therefore, they are generally perceived as stocks that should be avoided, especially by less experienced investors. Now, the cautionary note here is, look, very rarely a company might use a reverse split as part of a genuine turnaround plan or restructuring, and it might recover.
A diamond in the rough situation.
Potentially. But finding those hidden opportunities is very difficult and carries high risk, particularly for beginner investors. So the general advice, approach these with extreme caution, or maybe just avoid them altogether. At the end of the day, whether it's a stock split or a reverse stock split, remember these are all just technical adjustments to the par value of a stock. That's it. The most important thing always is the company's intrinsic value. How well is this business actually making money right now, and how much is it really expected to grow in the future? So as a beginner investor, rather than getting swayed by these kinds of events like splits or reverse splits, it's so crucial to get into the habit of thoroughly examining the fundamentals. What business is this company really in? What's its financial health look like? What are its genuine future growth prospects? Remember, a stock split can be a tool, maybe, to publicize a good company's success story, but it's not magic in itself.
That really brings it back to basics. So if we pull back and look at the bigger picture, thinking about our show's namesake, what advice did the legendary Peter Lynch give about all this? Stock splits, reverse splits. How did he view these events?
Well, Peter Lynch, true to form, didn't really view stock splits or reverse stock splits as significant factors at all when making investment decisions.
Not important.
Not really, no. His investment philosophy always came back to the intrinsic value and the fundamentals of the company itself. His thinking was pretty straightforward. Since a stock split or a reverse split doesn't actually change a company's real value, investors just shouldn't be swayed by these, quote, appearances. They should focus on the real business behind the stock ticker. That was his consistent advice. And this core wisdom, it really applies to so much more than just investing. It's about looking past the surface in life, too.
How so? Can you give an example?
Sure. Let's take some of his core principles. First, that famous one. A share of stock is not a lottery ticket. It's part ownership of a business. His insight here is that a split or reverse split, it's just an accounting event. It adjusts the face value, nothing more. It doesn't impact revenue, earnings, debt, none of the important stuff. He always emphasized that what you own is not a piece of paper or a blinking number on a computer screen, but a stake in a real business. It's like asking if changing that $100 bill for $250 makes you richer. Of course not.
Right.
And the life wisdom connection. Don't get swayed by superficial changes or fancy packaging anywhere. Whether it's a hot deal or a corporate rebrand, always ask, have the fundamentals actually changed? Focus on the substance, the real value, not just how things appear on the surface.
That makes a lot of sense. What else?
Okay, second, Lynch famously stated, there's a 100% correlation with what happens to a company's earnings over several years and what happens to the stock.
Earnings drive the stock price, long term.
Exactly. This insight is absolutely key for understanding splits and consolidations. He stressed that, over the long haul, stock prices inevitably follow the company's earnings growth, and neither a stock split nor a reverse split affects a company's actual ability to generate those earnings. A split might create some temporary positive sentiment, sure, but it's a short-term thing. Long-term gains only happen if earnings keep growing. Lynch would say things like watching daily stock price movements or relying heavily on technical charts were just distractions. Focus on the company's earning power.
And the life connection there.
It's about focusing on real progress. Lasting success, whether in careers or personal goals, comes from consistent effort and genuine growth, not just chasing fleeting trends or making superficial changes. Are you actually building real sustainable value in what you're doing?
That's powerful. And you mentioned a third principle?
Yes, his great analogy. Don't pull out the flowers to water the weeds.
I remember that one. Selling your winners and keeping your losers.
Exactly. It critiques that common investor mistake. Companies undergoing stock splits, they are usually the flourishing flowers. They're doing well. Lynch advised not to sell these flowers too early, but to let them grow, enjoy their success to the fullest. Conversely, companies doing reverse splits, they're often the weeds. His advice would be to critically reassess the business's fundamentals. Don't just buy more because the stock price seems low, and don't hold on forever out of some kind of false hope.
Cut your losses on the weeds, basically.
Or at least seriously question why you're holding them. And the life wisdom. Focus your energy, your resources, on what's truly thriving and contributing positively to your life or goals. Don't waste endless effort trying to revive something that's consistently struggling without addressing the fundamental issues.
Wow. That's such powerful, timeless advice from Peter Lynch. It sounds straightforward, almost like common sense, but you're right. It's the kind of bedrock principle that so many people seem to miss in the heat of the moment. What about other investment giants? Did they see it similarly? Do their perspectives maybe reinforce or diverge from Lynch's view?
That's a great question. And you're right. Lynch's philosophy often captures the absolute basics, the core truths of smart investing. Sometimes it can even sound a bit, cliche because it's so fundamental. But yes, you'll find that other giants echo his core message, maybe with slightly different words or emphasis, but they almost always converge on the same essential truth.
Like who? Give us an example.
Okay, well, consider Warren Buffett. He famously put it very bluntly. A stock split is just cutting the pie into more pieces, not making the pie bigger.
Ha, simple and direct.
Exactly. It's a powerful warning against that psychological illusion we talked about. Buffett constantly tells investors, don't fall for this. Concentrate only on whether the pie itself is actually getting bigger, meaning are the company's earnings and cash flow growing. He urges us to bet on the pie getting bigger, not just on the act of dividing the pie. His whole message reinforces patience, long-term thinking, and not getting swayed by short-term market reactions to things like splits.
Makes sense. Who else?
Then there's Benjamin Graham, of course, the father of value investing, Lynch's own mentor in a way. Graham famously said, in the short run, the market is a voting machine, but in the long run, it is a weighing machine.
Voting versus weighing.
Right. Stock splits. They influence the short-term votes emotions, trends, popularity, pushing prices up temporarily. A reverse split reflects negative votes, a low price due to poor sentiment. But from Graham's perspective, these votes are fleeting. In the long run, the weighing machine, the company's actual underlying value, will ultimately determine the stock price. So this raises an important question for investors drawing on Graham's ideas. For stocks that have split and risen a lot, you need to ask, is my margin of safety shrinking? That's the buffer between the price and the real value. Is it getting too thin?
And for reverse splits.
You need to dig incredibly deep. Is there any genuine hidden value? What's the real potential for recovery? Don't just buy because the price seems low after consolidation. Assess the weight.
Okay, one more.
Let's bring in John Bogle, the Vanguard founder and champion of index funds. His mantra was, don't try to beat the market, join the market.
So for him, splits don't matter much either.
Even less, perhaps. From Bogle's perspective, for someone invested broadly in index funds, individual company events like splits or reverse splits are almost meaningless. The impact of one company's split on a widely diversified portfolio is tiny, negligible. He stressed investing for the long term, capturing the market's overall growth through diversification. He'd argue that reacting to a split by buying or selling is just noise, likely increasing your costs through fees and taxes without any real long-term benefit. Don't get caught up in the short-term excitement. So, you see, Buffett, Graham, Bogle. Their advice, from different angles, it all really converges on the same core message Peter Lynch preached. Look beyond the split or reverse split itself. Focus on the company's intrinsic value, the fundamentals, and the long-term picture. What truly matters in investing isn't the short-term noise, the excitement or disappointment of the market day to day, but the actual value a company creates over time.
That's a truly fantastic summary. It ties everything together perfectly and brings us right back to our listener's original question about Costco, or any company considering a split. The key lesson here seems incredibly clear. At the end of the day, it's not really about the technical adjustments of the stock, is it? It's about the underlying business, its health, and its long-term potential.
Absolutely. Couldn't have said it better myself. So maybe a final thought for everyone listening. Next time you hear about a stock split or even a reverse split, try to pause. Ask yourself not just, will this stock go up or down, but really dig deeper. What does this event truly tell me about the actual business, about its health, and how does this piece of news fit into the bigger picture of genuine long-term value creation?
Excellent advice. A great place to leave it. See you next time. This was What Would Peter Lynch Do? Thank you for joining us today. Have a nice day.